We have an amazing panel for you here today.
Julia, before you introduce your panel, can you introduce yourself?
Yeah. Hi, I'm Julia Valentine. I'm managing partner at AlphaMille. We are a technology consultancy, and we also came up with the concept of Agile Family Office that Marty so brilliantly described. He does it better than we do. So when he talks about us, I just take notes. It's true. It's absolutely true. So today we have Benjamin Bornstein, partner with Three Line Capital, with us. We have Rebecca Fine, who is managing she leads Yield Street's art platform as the managing director of art investment and also Athena Art Finance. And we're gonna go more into the debt versus equity platforms and asset classes that you work with in just a little bit. And we also have Tony Acquadro, managing director with BroadRiver Asset Management, with us here today. Thank you so much for being here. I will ask you to please briefly introduce yourself and provide just a tiny little bit of an insight into your background and what you currently do, just to set the stage for all the questions I'll be throwing out there. And of course, we always welcome Q&A from the audience. You can stop us. You cannot stop us. Forget that. I don't know that. We are unstoppable. Right. Okay. So Rebecca, we'll start with you.
Sure. So as you said, I lead Yield Street's art platform as the managing director of art investment and Athena Art Finance. In 2015, I was a founding member of Athena with financial backing from the Carlyle Group to provide dedicated specialty financing to owners of very high value fine art. Before starting Athena, I worked for 25 years in both the art market and in art finance. I practiced as an art lawyer, basically doing as a transactional and litigation lawyer, advising world-renowned galleries, collectors, dealers, museums, and artists. And before that, I practiced as a commercial litigator and trial lawyer at Simpson Thacher and Wilmer Hale after graduating from Columbia Law School. And perhaps more importantly, the third generation of women artists and art dealers in my family. So for me, the opportunity to create the only diversified art investment platform for retail investors has been immensely exciting. So I'm really happy to be here speaking to all of you. Thanks very much.
Thank you. And you're my fellow alumni, by the way.
Terrific.
Different building though.
I was at Columbia College and law school.
I know.
Yeah.
You were too. Yeah. I was at business school.
Yeah.
So yeah, same campus.
Go Columbia.
Yeah. Tony, please.
Hi, my voice is shot. I'm Tony Acquadro. I'm with BroadRiver Asset Management. We're in the Empire State Building here in New York. We manage about 1.4 billion in mostly longevity and private credit type of products. We tend to focus on strategies that are uncorrelated to the market, idiosyncratic strategies that are very yieldy in terms of what our investors look at. We primarily cater to the pension endowment and qualified market. We have strategies in litigation finance, global trade receivables, senior secured lending and insurance, and life settlements as well.
Thank you, Benjamin.
Yeah, thank you, Julia and Marty, for inviting me here. So I'm like Rebecca, I'm actually the black sheep in my family. I'm the first of 3 generations not to go to medical school. And, sadly, I went to law school at your crosstown rival NYU instead.
I will do NYU too. So.
Okay, where are you?
There's
Yeah,
no
you
record. That was my undergrad.
It's all good. Yeah, so after practicing law for a few years, I went over to GE Capital, where I spent 10 years kind of learning the ropes on senior secured lending from soup to nuts. And in 2005, left the mothership, as we called it, to start a first of a series of investment platforms focused on acquiring and managing commercial loans, mostly senior secured, most often backed by real estate, but also by other collaterals. So as we sit here today, I'm now partners with Robert China, who an alum of Fortress for 17 years, and the two of us have sort of a big institutional background and knowledge base, and we bring it to targeted opportunities in the $5 to $25 million investment size space. We have three principal buckets of capital. One is partner capital. The second, and what I think is most appealing to the family office community, is we call friends and family capital. So we have high net worth investors, colleagues who we've known who are investing out of their personal accounts. We have family offices, we have small hedge funds who are investing in our smaller size transactions. Those would be called the 2 to 7 million. And then for the larger size transactions, call it the 7 to 20 million, we have institutional capital partners where we've had very long-standing relationships, going back to having worked with folks like Fortress, which is where I met my partner, Cargill, Carval, and other institutional investors. Again, we focus on largely senior secured lending, downside protection, largely uncorrelated to the market, and risk-adjusted returns that we think are far in excess of what you're going to see from most funds. So that's a quick summary of what we do.
Wonderful. So my first question is going to be for Tony and for Benjamin, and it's, where do you see the opportunities in credit markets 2022?
Well, then I have to talk my book. I mean, they're up until maybe a couple of months ago, there really hasn't been any yield in the markets. And what we tend to look at are, within trade receivables, is that we fund short-term trade receivables, which is what the banks used to do prior to the financial crisis. And for a number of reasons, they're no longer in the space for different regulatory, and so it's gone into the private market. So we see opportunity there. It's a shorter duration instrument. We're doing some stuff in litigation finance, particularly in Canada. So commercial cases we fund that are short term, and we're in the niche part of the market up there. We also have been a very, very large player in what is the life settlement market. Team came out of Goldman Sachs and ran the desk there for a number of years, and subsequently we put together a number of strategies from there. So we do that, and then we're also in the senior secured space where we lend to what are smaller managers in the space at very low LTV. And so we all come from, I would say, family office backgrounds, and where preservation of capital is first and foremost. So everything that we have is self-amortizing, so we really don't have to worry about when to sell, and too much about interest rates. So that's where we're currently seeing opportunities.
A question here already?
Marty, you can always count on me. Quickly on trade receivables, can you talk about, you mentioned duration, can you talk a little bit about spreads, what you're looking at perhaps, and also about any sectors? Is there a nuance about what trade receivables are better than others based on companies, et cetera?
Sure. The trade receivables market, I mean, it's like a $1.5 trillion market. If you knock about 500 off of that for commodities, we don't do anything within the commodity space. We do a lot of industrials. Duration is anywhere from 30 to 90 days on what we're looking at. Our spread is a percentage over SOFR. So as SOFR moves, we move with SOFR to that effect. And globally, it's usually with the U.S. obligors, and we're in North America and Mexico, parts of Europe, and parts of Asia, ex-mainland China. But countries where there's recourse.
So Yield Street also, they have a lot of different verticals, art being only one of them. So we also do litigation finance, supply chain finance, private business credit, litigation, real estate, and a number of other asset classes. But our paper's usually a little bit longer, but we're in all different industries across the board. But the yields are really significant. So I recommend you take a look at yieldstreet.com.
Thanks. We're going back. Thank you so much, Benjamin.
Yeah,
Opportunities.
yeah, we're seeing some really interesting opportunities in 2022. As a general rule, we like to go where other people don't like to go. So what we're seeing interesting right now in less liquid credit. So let me just back up a step. If you follow the credit markets, you'll know that spreads have widened considerably since really fourth quarter of 2021. And so in what we call sort of orphan type issuances on the less liquid side, we're following one now in genetic pharmaceuticals. We have another one that's actually an asset manager, and these are sort of three, call it $200 to $400 million issuances, where they're just small enough that a large hedge fund can't really deploy capital into it, and so we see some attractive returns occurring in that space. We think that sector of the market is going to continue to grow for reasons I'll get into shortly. Overseas, we're seeing opportunities. We've just been awarded a 25 million euro transaction in Italy. Really interesting for us, again, because the larger funds and larger firms have moved out of that space in Europe. We're able to come in on a secondary basis and find some interesting opportunities. As an aside, we're not looking at an investment opportunity unless we can see our way to a mid-teens, call it 15% plus type return. That's just where we feel that we need to be in order to be attractive to investors. And then otherwise, unloved industries. So we're seeing some interesting opportunities in, for example, metallurgical coal, thermal coal, pipeline companies, really anything that's, I'll call it non-ESG friendly. We're not trying to be a brown company investor, but for somebody who's a family office and doesn't have to worry about the publicity, we think this is a really attractive space. And then lastly, real estate, because of the bust from the pandemic, you're seeing a lot of office and a lot of retail. As of today, the opportunities aren't there. There's a bit of a bid-ask spread gap, but we think there will be some interesting positions coming onto the market. And last one I'll say as well, which is that now that we've got kind of the tightening of the credit, I think the old adage is, when the tide goes out, you get to see who's wearing their bathing suits and who isn't wearing their bathing suits. Well, we started to get involved in some New Jersey multifamily investments where there was a significant fraud involved that didn't affect the integrity of the mortgages, but really put off a lot of investors. And so we think there's going to be more of that coming as well, where there's risky borrowers or lenders who are out of footprint and shouldn't have been doing business in that space. So we're seeing opportunities across the board.
So opportunities in New Jersey is one of the first times this has ever come up in the outlook of 2022, which is great. Okay, so we will speak about art in just a moment, but while we were on the topic of the books that your firms have, what's the impact of the rising interest rates on the impact of the rising interest rates? Not necessarily on your portfolio, although you're welcome to talk about that, but also on the credit markets in general.
So the question is, what are the impact of interest rates on our portfolios? I mean, our lending is done at a fixed rate.
No, the rising interest rate.
Or the rising interest rate environment, right? So our portfolios are at a fixed rate, right?
Yeah.
So if we're at X and the rates continue to come up, I mean, we don't gravitate with majority of what we do. We don't gravitate, up with that. We also don't experience the fluctuations, within the market with respect to, with respect to trade finance. I mean, we move with, we move with the spreads accordingly. So
Okay.
did I answer that question?
Yeah, yeah, you, I
Accurately,
think yeah, you protect, you basically protect it, okay.
I mean, what we're saying is, it's really moving the market in a couple of different ways. So if you look at a chart, you'll see sort of a general steady decline over the last, whatever it was that Paul Volcker stopped smoking his cigars.
40
in the,
years.
Conference rooms. in
40-year
Congress.
cycle.
40 years, yeah, right. So what we're seeing is, number one, strength in pricing. So a deal that we were looking at 2 years ago, a land development deal, we're now 250 to 300 basis points wider than where we had quoted that deal 2 years ago, and very little pushback from the sponsor, from the borrower. In terms of forward flow, it's just going to create a tremendous amount of stress. There's going to be challenges for borrowers to meet their debt service covenants, excuse me, and challenges just to meet their, if they've got a floating rate deal, to make their interest payments at all, forgetting about the debt service covenant. So we're starting to see more and more stress and distress, which is great for us because we've always been stressed and distressed lenders. And, and the last thing I'll mention, just because I think it's sort of interesting in terms of, excuse me, the overall market, is that we're starting to see a significant drop off in new issues from the larger corporate credits. Because, just as if you had locked in a rate on your home mortgage, why would you go back out to the market when rates are higher now? So you're probably seeing a lot less issuance and maybe to some degree, a lot of flow into the secondary, strengthening pricing there in a way that would be unanticipated. So it's just something to keep in mind for sure.
One of the things I listened to in a presentation recently was the fact that a lot of people have issued debt, and given that we've had a TINA environment, there is no alternative, right?
Yep.
So they've issued debt and they've taken it out and bought back their stock, for example. There's also a huge amount of corporate issuance in the last several years with really crappy companies that have gone to market. And if, depending on the duration and maturity of that, there's going to be a reckoning in 12, 24, 36 months on this. That's going to be horrific. And I used to be on the trade at Citibank when Volcker was doing this, and we remember 14, 50% coupons. We're not going to go back there in terms of a cyclical yield, but you can, if you do a normal yield curve from 3 to 6 or somewhere around there, like remember guys, that's going to wash out a tremendous amount of people. And depends on how quickly they start doing.
And it will be interesting because, as you said, with these lighter covenant protections, it's really going to give a lot of, I'll call it, freedom to the borrowers and the sponsors to try to, let's call it, play games. We're starting to see this now. They call it creditor on creditor violence, where there's loopholes and they do asset shuffling and they can subordinate, existing first lien holders because they have lousy covenants and the companies that were permitted to do that. So you have to be extremely careful when you're looking at some of these larger syndicated loans for sure.
Thank you. Rebecca, let's talk about art as an asset class.
That's not so much rosier a picture right now. So over the past 25 years, contemporary art achieved a 14% compound annual growth rate, substantially outperforming the S&P 500. And between 95 and 2020, industry showed that art had almost no correlation with any of the S&P 500, global equities, or bonds. Since 2020, which is very recent history, the global art market has boomed, and 2021 was actually a record year for sales in the global art market, reached 65 billion. So in addition to the jump in volume last year, we're also seeing the average price of art sold at auction increase by 23% from 2020. And then to the early point, historically, art is also considered a really good hedge against inflation. JP Morgan recently published a study that said that on average, arts also performed significantly better over the last 40 years during periods when inflation is particularly high and rising. So it's at the moment a more optimistic outlook at least for the art space. But we're in equity and debt. We can talk about that.
Let's talk about debt first.
So Athena Art Finance is our lending business. Our clients are typically high net worth, ultra high net worth individuals, family offices, trusts with otherwise illiquid trust corpuses. We work with art galleries and art foundations. And to date, since 2015, we've loaned over 600 million, with loans ranging in size from about 2 million to 40 million. Because of our really rigorous underwriting and the experienced team and our proprietary data analytics that undergird our credit decisions, we have a really terrific track record, which attracted a lot of buyers. So we were originally a portfolio company of the Carlyle Group. In 2019, Athena was acquired by the fintech company Yield Street to provide retail investors with access to alternative investment opportunities like our diversified pool of secured art loans that were previously only available to institutions like private equity and the ultra wealthy. So when Athena's debt product was offered to our investors, there was insatiable appetite, and we decided to leverage our deep industry connectivity with auction houses and art dealers and galleries and private sellers to develop that we've developed through the years of working as a lender to create an art equity business, and that's sort of the newest asset class at Yield Street is this art equity fund business.
Tell us just a little bit about that.
So, in 2021, the end of 2021, we launched the art equity product to provide investors the opportunity to invest in diversified portfolios of artworks, all tangible art. We're not in NFTs yet.
No,
I'm
correct.
looking at you.
But I've been following the space since early 2000s,
Okay.
and the average asset as an asset class, art as an asset class for the last 30 years have been 19 to 25% opposed to what it has been the stock market, a lot less than that.
Yeah.
And there's a bunch of issues there, but interesting to see that you guys are launching, hopefully successfully, in equity, in art equity. So what's the portfolio composed of? What are you buying? How are you dealing with provenance?
Sure.
Who are your buyers? Who are your advisors?
All great questions.
Benchmarks, etc.
So, okay, our core thesis is that by focusing on acquiring only exceptional examples of an artist's most exemplary artworks with the most iconic imagery and from the period of their best artistic output, we can maximize the resale value of each artwork in the fund. And we are targeting net annualized returns of 16 to 20% conservatively. But we are acquiring the third art diversification is a really core principle of good investing, and it's also the way experienced art collectors build their collections. So our collections are comprised of a diversified group of blue chip, mid-career, and emerging
Right,
artists.
but you doing for post-war contemporary or
primarily.
masters or grandmasters
So
or
let me give you an
impressionists
example.
or
So we're focused, first of all, on artists who have a really demonstrated track record of strong performance at auction. The artists in, for example, the third art equity fund, which is available now, includes blue chip household names like Banksy, Takashi Murakami, Yayoi Kusama, but also really important mid-career and emerging artists like Stanley Whitney, who has one of the most celebrated exhibitions right now at the Venice Biennale. Amwaka Boafo,
so
Nicolene
living
Thomas,
artists, basically.
living artists.
This is like a series B of an artist.
Yeah, we this is like the greatest hits across the genres and styles. I mean, we are look, our
Yeah.
if you're investing in a single artwork, and we know there are companies out there that are doing this, right? If you invest in a single artwork or a single artist, the market for that specific artist or that genre or that style can fall in and out of favor, and you have basically 100% concentration risk and exposure to depreciation in value. We had spent years and years evaluating and diligencing art. To your point, my background as an art lawyer, I was involved in litigating issues around authenticity and attribution and title. So we are extremely focused on all of those issues, both in the underwriting of the artwork collateral and in the equity space, where we're very concerned with provenance. In fact, We think it's very important, where an object comes from, not only its history of ownership, but in good provenance can meaningfully increase the value of an artwork. So in fact, we're not telegraphing or publishing to the investors the specific artworks that we own. We are showing very, very close comparables, and we're providing a lot of information about the artist and the work, but we're not actually showing the specific artwork that we're acquiring. And
What is that?
well, we consider that let me start. We rely on the third-party appraisals, and we are purchasing artworks always at or below the fair market value, which provides immediate protection against sort of marginal decreases in price. But because we are not publishing our prices or the pieces, we're able to acquire works at very deep discounts. When you're publishing the acquisition prices and you're
Oh, no, I thought that you were not publishing the art piece. I get
Yeah.
that piece, yeah, I get
Right.
that part.
So we have, we have gotten really terrific response from the intermediaries from whom we're sourcing the artwork. And in fact, artists whose works are generally only available in the primary market, is very difficult to acquire, are very interested to work with us, in part because it means that people who weren't necessarily museum goers or people who are comfortable walking into a gallery to ask for prices are being exposed to art and art investing through exposure to our funds. So there's a big educational component, and one of the things that I'm excited about is the fact that we're offering opportunities to investors to really develop their understanding of why art is important and what they like, and we're creating all kinds of events to bring our investors directly to the curators and to the artists. Yes, question.
Sure. Back in the day, a friend of mine I graduated college with was an art major, and he went to work at Citibank. And Citibank was one of the big players in the beginning in the art world.
Yes.
Can you give me a flavor of how the private lending banking side of the aisle works with you, and who are some of the key competitors in terms of your breadth of the investment side? Is it morphed from the old school private banking of the JP Morgan and Citibank into this whole other piece?
In fact, it's an interesting question. So the reason that Athena was created was really because at the time, back in 2015, there were really only two types of lenders. You had your private banks that were making art-backed loans on an accommodation basis for the clients for a way to bring additional assets under their management. But they really weren't making art loans. They were not focused on diligence collateral because in God forbid, in the event of default, they had, the equities portfolio, the real estate. They were never really concerned with whether or not they were going to have to liquidate the art. At the opposite end of the spectrum, you had sort of loan-to-own, sort of pawnbroker type who were taking huge collateral administration fees, which effectively meant that if there were, something went wrong, you were going to lose all of your equity, and that was a really predatory business. We didn't like that. Sotheby's Financial Services was then as now offering financing, but really as a bridge to a consignment, because they would make, the auction house would make all of their money when the artworks are eventually resold. So we entered the space. We said there's a better way to do this. We offer really competitive rates. Our rates are competitive with sometimes lower than Sotheby's. They're obviously higher than the private banks. We are floating above SOFR now. But our rates are very, very competitive. And importantly, I mean, we really are designing bespoke solutions to address whatever the client's particular needs are. We work with family offices or trustees in situations where, for example, the kids are not as committed to the collection that their parents were, or it's not their particular, doesn't suit their tastes. And one of the beneficiaries wants out. So we do like a little mini leverage buyout and create, and the trustees love this because we can also pay their fees with the loan proceeds. But we work really to align with the client's particular objectives based on what their exit strategy is. Typically, we're expecting that the loans will be repaid as the artworks are eventually resold. So they're important as sort of for legacy, estate planning. It gives people the time to really think about strategic ways to to address a potential sale, avoid, tax, tax consequences of the sale, and really to, well, I mean, people use liquidity for all sorts of different things.
Is there any nuance, Rebecca, between domestic and international
Yes.
client bases, and what is?
So we
Could you
do
flavor
both.
that?
In fact, we both. We are, we lend into most creditor-friendly jurisdictions, which right now means that we lend, a lot of our borrowers are US based, but we have borrowers in England, in Singapore, in Hong Kong, in Switzerland, in the BVI, a lot of the offshore jurisdictions, Jersey, Guernsey. So, and outside of the US, we require that the artwork be held in our possession at fine art storage facilities. In the US, we have some more flexibility because of course we can perfect our first priority security interests by just, filing with PCC. But we do lend globally. Yeah.
Let me ask, just a second, we will go back to Q&A. I have one closing question because I would like all panelists to be able to summarize the value that they're providing to family offices. We'll come back to Art. It's such a fascinating topic. So your value proposition for family offices specifically, Tony, how would you summarize that?
I mean, everything that we do is has a yield-like quality to
Yeah.
it. So if people are looking for consistent, stable returns that are completely uncorrelated to the
To
markets,
the market, yeah.
to all markets for the most part, and all of our assets classes behave quite well in all market environments, with the key mandate of preservation of capital. I mean, that's really what we do.
Thank you so much. Thank you.
Yeah, I mean, we love working with family offices. The primary distinction that we see with family offices versus, let's call it an institution, is that you've got a very sort of unique personal presence, personal connection, and you're able to satisfy, I'll call it the high intensity, high touch requirements of the families. So, we're all about being there 24/7 to answer questions that come from our family office investors. We're responsive, we're predictable. From a structural standpoint, we are not a commingled vehicle. If you want to invest in, the next Fortress Fund or Apollo Fund, more than welcome to do that. But with us, there is no, you get to decide, do I like this investment? Do I not like this investment? And that has a huge appeal to people because there are so many dynamics going on within family offices where there might be an aversion to real estate. There might be a preference to real estate. And we can solve all those different, situations as they come up. Similarly with, investment sizes, some people want to be able to commit at least $2 million to a transaction. Other people want to dip their toe and would rather, commit at, it's called the $250,000 level. And so that's what we view as really exciting in our business, as how we're able to work with the different family offices.
And
Thank you.
I want to just make a plug for the debt business on the Yield Street side. So we pool all of our loans, and investors can earn returns based on notes that are synthetically linked to the borrower's repayment of interest and principal payments. And the targeted yields for the Yield Street diversified art debt products has been 9.5% since we started putting them on the platform. And we're going to be reopening those funds because everybody's very hungry for yields again. So we are kind of relaunching some of the diversified art debt products very shortly. At the art equity platform, we work with a lot of family offices that have an interest in either really for financial diversification purposes, but also where the family wants to sort of get its toes wet, isn't ready to commit to buying a $10 million collection, but wants to start to get exposure to art as an asset class and recognize that it's desirable because it's very low downside risk based on the way that we're curating these collections. They're a good inflation hedge. The returns are really interesting, and it's uncorrelated really to the equities market and a good inflation hedge. So those are the products. And then of course on the lending side, it's really just providing people with immediate access to liquidity that is otherwise completely locked up in their wall. And
Yeah.
those are the three ways.
Thank you
Can
so
you guys
much.
talk about what kind of rates that you're seeing in the space these days in your different, areas that you work in?
I cannot.
I can tell you, I mean, we've always had sort of a minimum, underwritten return on whether it's a loan origination or a loan acquisition of 12%. This is kind of in the, I'll call it the thick and thin days of negative interest rates, low interest rates. As I said, we bumped that return requirement by a good, 250, 300 basis points. Again, we're just not likely to get out of bed unless the return is in excess of mid-teens. And we're also highly focused on the multiple on invested capital as well. So, our typical investments, we're looking for a minimum of a 1.3x on your invested capital, which, if you do the math backwards, our typical hold periods are anywhere between 2 and 4 years.
So on our art debt products, it's 9.5% yields. And art equity, I mean, we're looking at the CAGRs for every artist that becomes, that is included in the fund. So in order to stay in the sort of high teens, 20% return, that sort of thing. Obviously depends somewhat on the composition of each individual fund, but that's where our targets are. And the art lending product, come see me afterwards. They're very competitive rates. I don't want to add. They obviously risk adjusted, et cetera. But our rates as a direct lender are also very competitive.
Hey, Marty, how are we doing on time for the question?
We've got about 5 more minutes.
So I haven't had the chance to meet you. I'm posting on Peter. I'm a
Very
party
nice.
here at the firm, and a lot more family offices. I'm interested in what you both mentioned, litigation funding. It's an area that's become very popular. One example, friends from a group invested in a chip technology related patent litigation. District Court made a judgment of $2.1 million. That was the first of 3 cases, one up on appeal. But I was first interested that you focus on, is it only Canada? And then secondly, with your background, is it just commercial litigation or is it across the board at different types of litigation? So
We have an effort, have had an effort in Canada for about 3.5 years, and strictly commercial litigation. We're not looking to go to trial. We're looking for settlement, and I'm not competing with the behemoths out there, the Bentham and Burfords of the world. We're looking for small to size cases that are, that we can put anywhere from 300,000 to up to 2.5, 3 million in. Most of them are pre-settlement, but we're also seeing some really very attractive cases that are post-settlement as well. So something that we didn't initially see. So for Fund 1, we're primarily looking at Canada. Subsequent vehicles may have a crossover. We've also been approached by a number of firms where we're seeing some interesting things in other verticals of the market. So many different verticals, but quite attractive in terms of multiples on invested capital, 2.5x to as high as 6.
So the litigation finance spans a very broad spectrum, everything from direct lending to law firm finance lending, as well as pre and post settlement. And we are in a variety of jurisdictions, including Europe, where we have some class actions, a lot of tort, and a variety of class action scenarios. So I'm happy to talk with you afterwards. But Litigation finance is actually the place that our president, Michael White, started his industry. Expertise is really in litigation finance, transnational, national, a lot of the the massive tort cases in the 90s. So it has been a really important, so one of our legacy asset classes, and one in which there's tremendous interest today. And we do partner with some of the behemoths you're talking about. So we do, it really runs the gamut.
I think the value in the space is seen as being non-correlated,
Yes.
Yeah. right?
Yeah.
And that's why
I mean, that's-
family offices like it in particular.
Yeah, and all of Yield Street is really about making available private, alternative investments that were not previously available to anyone other than sort of the big institutional players and the ultra high net worth.
Any thoughts on the change, move away from LIBOR? Any thoughts about that, or any other thoughts about the European credit or things like that? Or as you know, I think the European bonds were below zero at one point.
Yeah, I mean, I can't really comment very much on LIBOR versus SOFR, other than I think it was just sort of a general move to clean up the marketplace where they thought there was a little bit of funny business going on. In terms of what we're seeing in Europe, they've been living in I'll call it a negative real interest rate environment for longer than we have in the US. And so overall returns and yields historically have been lower overseas or in Europe. Obviously that's changed a little bit or maybe quite a bit, over the last 2 months, given what's going on in the continent. But, there's still, it's interesting. So in the space that we're in, for example, the family office and institutional investor markets are just not really so interested in pursuing, call it the, loans to SMEs and sort of smaller size loans. At least that's what we're seeing. So there's it's kind of this dichotomy that they're happy to go into the US on a commingled basis, but when it comes into their own backyard, it's just not there. So what we're seeing are really, for us, interesting yield opportunities where I feel like I'm going back in time 15, 20 years.
Right. I think there's a lot of confusion on the currency plays these days, right? Because I think the yen is devaluing, and meanwhile the US dollar is going up, et cetera. The ruble's up versus the euro.
Yeah. I mean, I think with the Euroization of the currency in Europe, it's really sort of helped a lot, even on the non-euro currencies. And so, what we view as it's a fairly stable relationship between the dollar and the euro, certainly within the timeframes that we're looking at on our investments, which is anywhere from 12 to 36 months. So.
And we really only lend in USD. I mean, we from time to time thought about lending euros, but we're at the moment USD based and really migrating to SOFR by default, which is where everyone else seems to be, I think.
Any thoughts, Tony?
No, I mean, we're dollar based as well. I just SOFR really only on one product.
Gotcha.
We have we have floors in our direct loans. We have floors.
Any other questions? Closing comments?
There was a question right there.
Who?
There was
Oh, yeah.
yes.
I had a question on the equity fund. It just intrigued me about not disclosing. Are there secure? I mean, I'm sure lawyers sign off on this, but is it a tough call? Is it I mean,
No, we obviously received advice. I mean, I think the investors are really relying on the manager's expertise and judgment. In every instance, when we describe each individual artist in the fund, the comparables are very, very close to what we're actually buying. And we're about to do sort of the first reveal of a specific artist under very, very specific circumstances where there's no sensitivity from the seller. We're able to do it from a copyright and trademark perspective for very unique circumstances. But this has actually been very important for us in enabling us to really source the very best quality. because we also have a hold period of we 5, potentially up to 7 years. So that, you know, it's possible that people wouldn't remember that it's owned by a fund, but we think that there's still enough of a stigma associated with that. And we're watching some of the competition be sort of badly punished by the fact that these artworks are basically being shopped around, and you know, the rarity of an object, it being fresh to market, all of these qualities still very much matter when you're reselling art.
But that rationale, it's based on the artist's sensitivity about this, you know, you're
Oh, no, not-
purchasing something below a market value when you don't want to.
No, not necessarily. No, that really goes to the acquisition price. So
Right.
we're not disclosing the acquisition price
Right.
either. No, I think the objects themselves perform much better at sale when they are fresh to the market, and there's a sense that the object has, you know, a really important provenance, and that the art market hasn't already seen the object in the last many years. A lot of the objects we're buying have been held privately for more than 20 years. Obviously, living artists have different sensitivities. Their galleries will be very loath to sell if they don't feel that the artist market is going to be adequately protected, and they're very invested in ensuring that these artists' markets are insulated from volatility, and they don't want to see people flipping for obvious reasons. So really, we are very sensitive to that, and because we're really mindful of the legacy. I mean, we're custodians of these artworks for a period of time, and we want to make sure that that time is meaningful and important, and that we're conscious of the role that we're playing. And I think that has been important for the intermediaries with whom we are dealing, because they're very happy under those circumstances to get their artist's work out there to a broader public.
Well, great job. Thanks so much.